Fears of military conflict between North Korea and the United States has rattled most asset sectors over the last week or so, driving 10-year Treasury yields to the lowest since June. Our next guest sees geopolitics as a big risk facing bond markets. Raymond Lee is a portfolio manager and head of credit at Kapstream Capital, managing over $10 billion. Raymond, great to have you on Real Yield. In context, though, Treasuries haven't really reacted as much. Is that surprising to you?
No, not really. If you look at Treasuries over the last couple of months, it's been ranging up between 2.2 to 2.6%. It is trading on the lower range of that. Partly that is because of the North Korea escalation, in my view. And for it to trade even tighter, you're going to have to see an escalation of that. And that's kind of the biggest unknown at the moment.
Is that lag behind the actual sort of, more elevated levels of risk off when it comes to equities, FX? Something that you would expect out of the bond market?
Yeah, sure. So look, in the past, the markets have looked through this North Korean crisis. This is not the first time it's come up. It comes up kind of every year. They test missiles. Most of the times, the markets look through it. I think this time it's slightly a bit different just because Trump is a little bit more unpredictable as a president. So you've seen a little bit of a sell-off. You've seen VIX kind of tick up to around 15%, but you haven't seen a massive broad sell-off as yet. But we need to track it to see how this escalation goes going forward.
I mean, it's still all down to the Fed, right? And that sort of soft-ish inflation rate we had on Friday, that kind of just, further, I guess, gives a bit more to the story of lower inflation for longer in terms of the tightening trajectory. The Fed's going to take it real easy. Yeah,
look, I think so. We had the inflation print on Friday. It was okay, but it was slightly below expectations. It's around 1.7%, and the Fed wants it to be at 2%. Look, hopefully we'll get there next year. You've got a tight labour market. Wage inflation is around 2.5%. The Fed has said that if wage inflation ticks a little bit higher, closer to that 3%, you might see that transfer into core CPI.
Does that mean the greenback is still a one-way bet?
Look, so the US dollar has, basically, sold off recently. I think part of that is just because Trump hasn't been able to get any fiscal reform through. From my
you say that, there's still the markets are still looking at the presidential put, not the central bank put. Is that really the case, though? I mean, it doesn't feel like that global markets are being driven or US markets are being driven by any expectation of any policy going through.
Yeah, sure. So look, I mean, when you look at the central bank put, central banks can actually do what they say they're going to do because they can cut rates and they have the autonomy to do it. In terms of presidential put, Trump doesn't have the power to enact policies. He has to do it through Congress. And so after he got elected, the market was pricing a lot of that in, and that's why equities are at all-time highs. But he hasn't been able to get stuff through yet. And so he's got another, call it 16 months or so to enact legislation before the next midterm elections. And if it doesn't do that, then you might see risk assets continue to sell off.
Well, how does that fit into your strategy then, Raymond, at the end of the day? I mean, what's your top conviction here? It does seem as though you're playing it a bit safe, to say the least.
Yeah, sure. So in terms of our overall strategy, what we're doing basically is we're still going long corporate assets. We believe investment-grade corporate assets at the 5-year level offer very good yields, particularly in Australia. IG 5-year bonds are giving you kind of 4%, which in this environment is pretty good. We're not taking much position in interest rate duration views just because it's a lower information ratio trade. So we have a little bit of US duration, but not a whole lot at the moment. And most of that duration, if anything, is coming from Australia. It's kind of one of the highest rate environments in the developed world. And so you're going to get some good carry while you hold on to those bonds.
Right, so that's the juice. When are we going to get some juice in the Treasury market, or more juice there, given the possibility we may not get a rate rise now, perhaps in December or even later? And part of that, of course, coming from that inflation reading and, I suppose, generally the economy not quite as growing quite as fast as perhaps Janet Yellen and others would like.
Yeah, sure. So I think that just depends on the data that's got to come out. I mean, remember, the Fed has been hinting that they're going to do balance sheet reduction potentially in September. So my guess is if they do that, then they can delay the rate hike for a little bit longer, maybe to December, possibly first quarter next year. Obviously, the inflation print, the next one is going to be very important. If they can get some momentum going upwards towards that 2% mark, then they can do the balance sheet reduction and potentially hike rates again another time in the end of December.
Well, let's try and finish up where we started, and that is to do with the Korean Peninsula. Notice that you've been selling some Korean bonds, taking out some credit default insurance as well, CDSs here as well. Now, tell me something. You're also perhaps looking to short the Korean won, so perhaps you are anticipating things to heat up more than you're suggesting.
Well, look, we're bond investors, so we're always focused on the downside. Look, for us, as a portfolio perspective, we don't have a lot of exposure to Korea. It's about, it's less than 5%. And what we've done over recent days is we've trimmed some of those bonds. And the other way you can kind of protect yourself through this tail risk event is obviously buying some protection on Korean CDS, and particularly also just shorting the won, which is kind of being range-bound recently. Look, I still view it as a tail risk event, but just to be on the safe side, you don't want to lose the returns that you've made during the rally this year through not being prudent in the risk management. So that's what we're doing from a portfolio perspective, but it's still a very small part of our portfolio. Everything else that we own, we're still generally long the market. Spreads have been coming in, and so you want to be long risk assets, and we bought a lot of corporate bonds that have made a lot of money for us this year so far.